Hello, hi everyone. So, welcome back again with another video, another beautiful session, and almost the end of our chapter number 2. I'm taking a bit long. I'm stressing on the things which are required, like the ANSOF model is very, very important. So, I took approximately 30 minutes for it only to understand every single bit of it. Now, in the same way, when I took Arthur D. Little portfolio matrix in the last video, I think I just overallly told you that this particular matrix consists of the competitive position and the industry maturity, like how and when the maturity, or like how and when the industry is being matured. First is embryonic stage, then comes is the growth, then here you see the first embryonic, that is the infant, where it is easier growth. I am just repeating it so that it is better for you, and if for example I have forgotten some points there, you can just jot down the points here. Next comes is the growth stage, then comes the maturity, and then comes the aging. If you see, it is same like the life cycle, where it says about the infant, growth, then maturity and decline. Same type, it is like this, and it's same way. Okay, so what happens in embryonic stage? The earlier stages of an organization marked with easier growth. Okay. Next, in growth, it holds the market position and even grows it. This is all we have done. Maturity is all stabilized. It is not high, it is not low, but yes, it is a stabilized position. It is not growing further, but has a strong brand image. Once it is in a maturity stage, for example, if you are buying a one plus, now the one plus situation is in the maturity stage, means it has stabilized its way, its record in the market, and the competitive position is very, very dominant. Okay, so people mostly, if they have money, they try to buy that. Okay, next comes the aging, where what happens, the company is losing the market, it is just falling down, declining, it is coming into the war horses or the dodos, as I also said you. Now, competitive position, is first position is if it is a dominant if it is a dominant position, then the position of the company falls into the criteria, in this criteria. If then the position of a company falls into this criteria, if when it is a clear market of the leader, it is a market, write it there, market leader. If it is a market leader and it has a monopolistic position, there is no one except that particular thing. Okay, like Intel in microprocessors, which we have the processors, the small chips which we have in the laptops and our systems which we are using, PCs. Intel is one of the beautiful, one of the beautiful company where it has been in a dominant position since a long time. There is no one who is coming and overcoming that Intel, or there is no substitute to the Intel if for now. Okay, now coming to when it can be a strong position. Strong position it can be when the company has not to be a monopoly. It is not a monopoly, but definitely has a strong presence. Like example you can write is OnePlus. It is not a monopoly because it has many other brands also, like Nokia, like it is giving good products in Samsung, as it is giving good products in Oppo, Renault, and many other things, right? So OnePlus is one of the mobile brands. It doesn't be in a monopoly, but yes, OnePlus has a beautiful presence and the loyalty of the customers is being there. Are you able to understand? Yesterday I did it. I'm repeating it, just 2 minutes I'll take, and then we can again go into the chapter. Okay, then comes the favorable situation. When will be the favorable position, or the companies can have a favorable position? Usually operate in fragmented market, and no single one controls all market. Okay, fragmented fragmented market. Remember this one is what, this one what you will write, this one you will write is not monopoly. Writing with me? Yes. And but has a loyal customers, and strong presence. This is what you have to remember. This is what flash notes I'm saying. It is saying that the position usually is operating in fragmented markets in different small markets, and no single one control of all the share. Okay, so it is just in a favorable position where your company is being distributed into different parts of the markets, and every market has that particular company to be sold. Okay, so you can say, right, fragmented market. This is a keyword. Next coming is what? Tenable. What is tenable? Tenable means here each company caters means it distributes to a niche segment. Niche means specifications. Like, I'll say you like now example I'm giving mine. For example, like I have started a company. Okay, I've started a company where it is doing a production of of earphones. Okay, earphones. And this earphones works in Bluetooth, works in Wi-Fi, works in when I give a command from my phone, uh, from my voice, it will work, as well as if I clap, it will work. And it is very sensitive to the voice. And so you have also put the Google Assistant in that earphones. So what is it? Earphones is not a niche product. Earphones having these all specifications where it has not been developed till now, and that specification is so beautiful. But yes, you will have a very less market for it. Very less market for it. Okay, so it is saying it is a product variety or segmented demographically. Very less people will buy. Very true. It will be very lessly sold, but it has a niche product. Okay, now I'll say one more example. Now I have started telling you, specifying you, doing a lot of research on budget analysis. Okay, that is my specification. I get clients only on the analysis of the purchase. I get people who tell me that you do budget analysis and give us. I get paid for it. What is it? It is a niche. It is a skill which I have developed myself, and I am being selling that niche product in so beautiful way. And in that budget analysis, I'm purely giving them a different type of models which no one has yet given. Understanding? Everyone understanding? Okay, now another example. We have a phone. Okay, we have phones. I think Oppo we have, and many other phones where you see the front camera. Here the open it will pop up camera is there. I think it is of Oppo, as well as they have also started in some other company. When Oppo started, it was a niche segment for it. Okay, but slowly it got competitive advantage, competitive rivalries. And then Oppo thought that you should change something and bring on something new, so that the product remains very different, very variety, and it is segmented to very small part of the people. Got it, everyone? So you're writing the example: Oppo pop-up camera. Okay, and so, okay, next example. Next is weak. Okay, when it will be called as weak, when a company will be in a weak position, a company's financials are too weak to gain hold in the market, and it's expected to die within a short span of time. Die or divest, which we read in BCG matrix. Remember? Okay, weak, where what happens, the company is into a totally in a downfall. It is very low, has a lot of debts, has a lot of outstandings. It is not it is weak to gain the strong position in the market. So it is better it goes declines, or it is removed from the market sales. Got it, everyone? With me? Come on. Competitive positions can be of these varieties. First, dominant example is Intel. Strong, one plus. Favorable example is those companies which have which has been Fragmented means they have been breaked up and divided into different parts, and that company has a value. Not much, but yes, it has a value, it has a share. Tenable means oppo, then weak position means it goes, dies, and divest. Okay, now in this weak position I can give you an example of i um, iPods, which we had before we had these iPods. Now these iPods are of no use. No one is using it. Apple iPods. In BCG matrix, I showed you how the Apple iPods look like. Remember, it is of dog's position. That only. Okay, fine, very nice. So I think we have done a revision of our Arthur D portfolio matrix, and I'm just wanting to do revision because I felt that we should have specified little bit more in the last video. But all those people who do not know me, myself is CMA Vikita here, come, we have come across to help you off, to make you understand, to actually learn with us the strategy management marathons. Make sure that you download our PDF from the drive, and the link which will be given to you as soon as possible, and watch the video till the end. Please, if you like it, please put the like button, give us a valuable feedback, because it will be a very helpful and a positive note and a positive vibe for us. Thank you so much. And yes, now with a beautiful smile, a big smile, let's begin the class. Okay, so we are now going to understand, we have come to the strategic planning. Strategic analysis till now we were doing, and now we are doing is strategic strategic planning. Okay, everyone, super. So what is the stages involved in the strategic planning? Strategic planning has 3 stages. What are these 3 stages? First stage is the option generations. Generations means alternatives, finding out the alternatives. Okay, second stage is says about selecting or evaluating the alternatives. Evaluation of option generations. Okay, super. Next comes is that there should be selection of any particular option. Am I clear? These are the 3 strategic planning stages, and beautiful stages, not to forget. It is 3 stages. Remember, recall with me. There are 3 stages of strategic planning. What are the stages? So easy. First one is for strategic planning. You need to find out what are the different alternative options we have. With those alternative options, we need to find out, we need to evaluate what this out of 10 alternative. If, for example, we have, just imagine, this is one strategy, 1 strategy, 2 strategy, 3 strategy, 4 strategy, 5 strategy, 6 strategy, 7 strategy, 8. Out of these so many strategies, these are what? These are option generators. Now we have to evaluate. Evaluate means we have to find out that in each particular strategy option available, what can be the particular evaluation if we are doing it. Like we have to put a proper rating to it, whether this will be 8, this will be 5, this will be 6, this will be 7, this will be 1, 2, 3, and 4. Okay, this is how we are going to evaluate the options, thinking about the future, thinking about the weaknesses, thinking about the threats, thinking about the opportunities, and thinking about the maximizing the strengths. Got it? After evaluating these particular option generators, out of these, the strategic manager with the board of directors and the high level authorities need to sit and check that out of these there are 2 or 3 which can be useful for this particular scenario, and then they select one from the whole list which we have as the strategic alternatives. Got it? I mean strategic options. I hope you have understood. Now, here, if you see, I'm just making you read strategic option generations. At this stage, a variety alternatives are considered and relating to the firm's product and market, its competitors, and so forth. Examples of the strategies are increase market share, penetration into the international market, concentration on core competencies, and accusation and expansion. What are the strategies to be adopted for this particular stage? Is these: it can be increase in market size, penetration into the new market, concentration on core competencies, and acquisition or expansion. Then comes the strategic option evaluation. Each option, as I said you, each particular option which we have, strategy 1, strategy 2, strategy 3, strategy 4, every particular option must be given time, properly stressed out, finding out what are the weaknesses, what are the strengths, what are the opportunities, what can be the better alternatives for particular strategy, whether that particular strategy will give you a output in a better way, is it a long run, is it future oriented, everything should be properly think. See, existing strengths, evaluate the existing weakness and finding the existing position, and is it acceptable by the stakeholders. These questions should be answered. Then comes the last stage, and it says choosing between the alternative strategies. From the above you choose the alternative strategies. This process is strongly influenced by the values of the managers in selecting the strategies. Got it? So what are the three stages? Everyone repeat with me. Three stages, ma'am. The first one is option generations or generators. What can be done in this? You can increase the price. You can go into the core competencies and many other things. Then comes is option generators. After option generators, what you have to do? You have to do the evaluation of the option generated, find out the strength, weaknesses, opportunity, threats, and whether the stakeholders will be accepting or not. Next comes is select from the best evaluated options by the managers and the strategic managers and the head of the departments. Okay, this is how you have to write. Got it, everyone? Are you remembering? Are you able to recall with me? Are you people there with me? Come on, superb. Now coming to the steps of strategic planning. See, that were the stages. Now I'm coming to the steps. So the first step is you have to find out the strength and weakness. Okay, then you have to do environmental analysis. After that, you have to summarize the current situation, whichever present situation you are there. You have to check properly. You have to give a jot down points on what your current situation is saying. Analyze the situation properly, and if required, develop a mission, vision, and a purpose statement for that particular business or organization. Then you have to set a goal. You set a goal, define objectives and support the above goals, develop the strategies, and then use the key tactics. Got it? Easy. So come on, repeat with me. You repeat and write with me also. Come on, I am also writing with you. So let's write. First is SWOT. In SWOT, it is internal factor analysis. Okay, strength and weaknesses. Then you have to do environmental analysis, which says about opportunities and threats. Okay, then you have to summarize present situation. Everyone, present situation. Then if you find that present situation is not that comfortable, then you have to define the mission, vision, and purpose statement. After that, you have to set goals. And after setting goals, you have to define the objectives. You remember I had told you that there is sometimes an exchange of goals and objectives. Sometimes goals are used above and objectives are used below. There is an interchangeability between goals and objectives, which we have read it in the earlier of this chapter only. Then after defining, it will be develop strategies. After developing strategies, add the key tactics. What is tactics? Already explained you. Art of behaving differently with different people is called tactics, and this tactics can help you achieve the proper thing, and it can be called as the steps in strategic planning. Everyone done? So this question has been asked, so make sure that you read it properly. Okay, now let's understand the difference between strategic management and strategic planning. Here it has been asked in 2018 June, so we'll read that. Okay, strategic planning and strategic management. Strategic planning is what? It is a future oriented activity. Important question. First of all, strategic management implies a bundle of decision and moves taken in the relation to the formulation and execution of strategies to achieve the organizational goals. Here it tends to determine the organizational strategy and used to set priorities. Management is different, planning is different. Planning is future oriented. Here it is related to the formulation, execution, and many other things. Okay, sorry. Next, strategic planning is a management by plans. It is management by result. Analytical process identifying actions is to be taken. Here action oriented process identifying is to be taken. Fine. So strategic planning, strategic management difference is also done. Now let's understand the difference between the corporate planning and long range planning. Before I go with the corporate planning, yeah, if you see in our book only, it is given very nicely about the strategic management and the strategic planning. 2018 question has come, so I feel it is an important question. So before we go, we should understand about what are the approaches in the strategic planning. See, this is an important question. So what are the approaches? There are three types of approaches. Top top down process, top down process, bottom up process, and iterative process. Important question. 2019 they have asked, 2018 they have asked. They can ask you simply that what is top down process. So here it is nothing much there. Here if you see, this is the hierarchy, this is the higher people, then lower, then the other part comes, right? So if you see, top means from up till down, it is called top. From bottom means down till up is called bottom. And then iterative means it is a loop. This and this both, it is a loop. Okay, it involves both the top and the bottom getting the targets done. So that is what, if you see, is given, the managers are given a target to achieve, which can be done and passed down to the lower levels of the management. Okay, that is called top. Bottom means it is a functional and line managers which coordinate with the upper staff and making sure the targets and budgets given by the higher authorities are being properly fulfilled and approved. So this is how you have to read. Okay, clear? Now coming down, strategic management and strategic planning difference done. Then corporate planning and long range planning. Okay. Before we understand about corporate planning and long range planning, let's understand about strategic planning and long range planning. Strategic planning versus long range planning. Strategic planning has more consideration. Long range planning is where we want to be and what we want and where we want to be. Strategic planning says about resides on, I mean, it purely speaks on internal and external stakeholders, and long range planning speaks purely on um, outside world budget and physical budget. Okay. Strategic planning is responsive to dynamic and changing environment. Long range planning is vastly saying about it is reliable on the futuristic nature only. Got it? Now see, here if you understand, this is more easier for you to understand. Long range planning. Long range planning, what happens? It is forecasted on these budget programs and profit plans, and these all are been combined and then it is being implemented. As it is implemented and then it is been, it has operational control, means after implementation and evaluation, if there is anything to be changed, it goes back again to the loop and then changes it. Okay, that is called long range planning. What is called strategic planning? Strategic planning says about the prospects and the objectives, and here there is strategy which is being maintained, and this strategy can be of operating performance as well as strategic goals. So it says about two important parts, that is it can be from the SBUs, or it can be from the business unit, it can be from the units of the particular company, or it can be project wise also. Okay, so if it is by the units it's called operating control, if it is by the projects it's called strategic control. So it can be an important question to ask. Okay, question, remember this. Now, so now I'm going to the depth of corporate planning and long range planning as per our book. What is given? Let's understand that. Okay. So it is saying that I'm reading it. Please make sure that wherever I'm focusing it, properly underline or highlight it. And I will explain some important words which we have to remember. Corporate planning, it is concerned with the determination of objectives and treating the company as a whole. Okay. Treating the company as a whole. It develops it develops means to achieve the company's overall objectives. Corporate planning is saying purely about corporate way of planning, and it can be done through the determination of objectives, and it is for the overall company's development. Okay. Corporate plans may relate to achieve the corporate objectives for short run and long run, both ways. But in the long range planning, it is purely the future oriented, future anticipated. It is always about the future, not related to the short run. Understanding the difference? So, corporate planning is an integrated system approach where it considers the functions, divisions, units of an organization or a company. Hence, it is called integrated system approach. If question comes, everyone, come on, you have to write this question. If question comes here, if question comes that, do you think that corporate planning is an integrated approach? You have to raise these things. Answer. You have to say yes, it is an integrated approach. But why? Because it makes sure that it is developing the whole organization or the company with its functions, with the divisions, with its units. And it also makes sure that is overall development of the company's objectives. Such corporate plans at a corporate level are being framed by the corporate level, that is the top level of the management, that is the CEO, CFO, board of directors, and this main head of the department, main head of the corporate level. Got it? So this is, and another thing, corporate planning helps you to make the corporate objectives not only for the short run but also for the long run. So whatever points I wrote, pause there, write flash notes in your copy. Why? Because you will really think that you are listening, but later you'll forget. Pause it there, calm yourself, note down, and again, play it on. Very good. Now, long range planning is what it is: a systematic and the formalized process concerned with directing and controlling future operation. Long range, long, future oriented, futuristic, going ahead, thinking about anticipation on what can happen after 10 years, after 5 years. It is thinking about over a 5 years, over down the 5 years of line, giving an opportunity to the management to anticipate future problems and can be more flexible in framing the future long range plans. Okay, so this was that. Now there can be a question asking that, write down the question can be asked: corporate planning is, do you think corporate planning is similar to long range planning? You have to say no, corporate planning is not similar to long range planning. Why? Because corporate planning concerns longer period, but long range planning purely focuses on the futuristic or a long range, long run period only. Okay, then you write corporate planning depends on how, it's right that a time span depends on how far a company wants to forecast, and it is depending upon its overall objectives of the company. Okay, corporate planning in an engineering firm. Another question that corporate planning in an engineering firm will involve what, and in an textile firm what. So you can say corporate planning in an engineering type of firm will involve long term considerations. Why? See, if it is an engineering firm, what happens? This is a person, these are people who are working in this engineering unit, okay. Now you say me, they are working in this engineering unit, that is Tata Steel. Now this Tata Steel is doing a production of some, iron rods or steel table, okay. This steel table, do you think that this steel table can be manufactured, sold, and then marketed in one single day, or within some 3 months, 2 months? Within a small duration of time or a shorter run, can it be done? No. That is why it is always said that the engineering firm is taking a long term objectives, but whereas if it is the same people who are working for a cloth manufacturing industry, manufacturing shirts and pants or t-shirts, then what will happen? They can do a production in a shorter duration of time. They don't require much of thing because it can be sold, it can be marketed also easily, but these type of products cannot be marketed easily. Understanding, everyone? So the here corporate planning, you write here that corporate planning in an engineering firm involve the long term consideration, but will have short term consideration in case of textile firm. Long range planning necessarily connotes the planning with a long term horizon over the 5 years down the line. I hope you have the understood. Okay, everyone has understood? Super. The corporate planning is associated with the long range planning. Long range planning, and in the labor intensive industries, it is saying it is associated with the long range planning in the labor intensive industries. Corporate planning is concerned with is concerning market as well as the new products and the new market. See what strategies it is using. Everyone remember, exist market, existing product means market penetration, as well as new products, new markets means the both the extremes, that is diversification. I hope you are understanding that this is the strategy which we have read. But long range planning takes care of existing products in the existing market only, that is market penetration. Got it? Very good. Superb. Everyone is with me. We are reading it very nicely and calmly and nicely. Okay. So let's go down. You're covering everything slowly, slowly. Okay, let's keep it for this much. And the next class, we'll read about the contingency planning. What are the alternatives of the contingency planning? And we'll end up the chapter very soon. Thank you so much. Please make sure that you revise, calm yourself, rewind yourself, and refresh yourself. Come back to the next lecture and watch it properly. Thank you so much. Bye bye.